Welcome to the video. In this video, we'll talk about high probability and high profit trade with broken wing butterfly. When you buy stock, you make profit when the stock goes up and suffer losses when the stock price goes down. We already know that by using option strategy, we can increase our trade win rate. Broken wing butterfly is one of the high probability and high profit option strategy that we can use for neutral to bullish or neutral to bearish trade. The broken wing butterfly trade also has a limited loss, which allows this strategy to be used on high price stocks like Amazon, Tesla, and Google, even when the trader has small capital to trade. There are two types of broken wing butterfly, which are credit call broken wing butterfly and credit put broken wing butterfly. The credit call broken wing butterfly has a neutral to bearish assumption of the stock. In contrary, the credit put broken wing butterfly has a neutral to bullish assumption of the stock. Let's look at how to set up the trade. First, let's look at how to set up the call broken wing butterfly. The call broken wing butterfly consists of buying an in-the-money call spread and selling an at-the-money call spread. This is the Apple option listing for January 21, 2020 as of January 1st, 2022. The stock price is $178.20. To set up a call broken wing butterfly, the trader can buy a 172.50 and 177.50 call spread and sell a 177.50 and 187.50 call spread. Basically, the broken wing involves selling two call options that the trader thinks where the stock price will be when the option contract expires, then buy a lower strike price call option and buy another higher strike price call option that allow the trader to collect premium from the trade. In this example, the trader will collect $24 for the trade. Take note that the trade premium is calculated using the mid price of the trade and ask price. This is a profit and loss profile chart for the call broken wing butterfly trade. As we can see, the maximum profit is $524 if the stock price ends at $177.50. The maximum loss is $476 if the stock price goes above $187.50 when the option contract expires. The break-even point is $182.74. And important aspect that making this trade a high winning probability trade is the trade will not lose no matter how low the stock price decrease. Let's look at how we get this number. This is the profit and loss chart breaking down the profit and loss of the two call spread that making up the call broken wing butterfly trade. The 172.50 / 177.50 debit call spread costs $330 and the maximum profit is $170, which is the width of the spread, which is a $5 or 500 minus 330. The call spread break even at $175.80 and suffer maximum loss of $330 when the stock price goes below $172.50 and achieve maximum profit when the stock price goes above $177.50. Meanwhile, the $177.50 and $187.50 credit call spread collect $354 premium and be able to keep the premium if the stock price stay below $177.50. Then the profit start to decrease, break even at $181.04 and suffer maximum loss of $646 at stock price above $187.50. The profit and loss of the call broken wing butterfly is the combination of the profit and loss of the two call spread. Hence, the trade will not suffer losses when the stock price drop because the maximum profit from the $177.50 and $187.50 credit call spread is higher than the $172.50 and $177.50 debit call spread. The call broken wing butterfly spread making maximum profit when both the call spread making maximum profit at $177.50. When the stock price is going higher, the loss from the $177.50 and $187.50 credit call spread is more than the profit from $172.50 and $177.50 debit call spread, which is why the trade start to lose money when the stock price goes above $182.74. Now let's look at how to set up a put broken wing butterfly. Same as call broken wing butterfly, the put broken wing butterfly consists of buying an in-the-money put spread and selling an at-the-money put spread. In this example, the trader can buy a 185, 180 put spread and sell a 180 and 170 put spread. The trader will collect $33 for the trade. This is a profit and loss chart profile for the put broken wing butterfly trade. The maximum profit is $533 if the stock price is closed at 180 when the option contract expired. The maximum loss is $467 if the stock price goes below 170 when the option contract expired. The break-even point is 174 and 67 cents. Similar to the call broken wing butterfly trade, this put broken wing butterfly trade is a high winning probability trade because the trade will not lose no matter how high the stock price increase. This is a profit and loss chart breaking down the profit and loss of the two put spread that making up the put broken wing butterfly. The 185-180 debit put spread costs $328 and the maximum profit is $172. The put spread break even at 181 and 72 cents and suffer maximum loss of $328 when the stock price stay above $185 and achieve maximum profit when the stock price drop below 180. Meanwhile, the 180-170 credit put spread collect 361 premium and be able to keep the premium if the stock price stay above 180. Then the profit start to decrease if the stock price decrease. Break even at 176 and 39 cents and suffer maximum loss of 639 at stock price below 170. The profit and loss of the put broken wing butterfly is the combination of the profit and loss of the two put spread. Hence, the trade will not suffer loss when the stock price increase because the maximum profit from the 180-170 credit put spread is higher than the 185-180 debit put spread. The put broken wing butterfly spread making maximum profit when both the put spread making maximum profit at 180. When the stock price going lower, the loss from the 180-170 credit put spread is more than the profit from the 185 and 180 debit put spread, which is why the trade start to lose money when the stock price drop below 174 and 67. What can we do if the stock price goes against our trade? Unfortunately, not much we can do with broken wing butterfly trade. What we can do is treating the trade as two separate spreads and close the spread when we're able to get close to full profit. If the stock price whipsaw before the option or contract expires, we will be able to make more profit overall. On both the call broken wing butterfly and put broken wing butterfly trades, the trade will be profitable trade if the stock price stay the same, move on one side, and a small move on the other side. Hence, the probability of making the profit from the trade is higher than just simply buying the stock. In terms of profit, on both the trades, the maximum profit is higher than the maximum loss. This is why the broken wing butterfly strategy is known as a high probability and high profit option strategy. And the limited loss of broken wing butterfly allows the strategy being used on high price stock like Amazon, Netflix, Tesla, and Google, even with a trading account that has a small capital. Thank you for watching. I hope you enjoyed the video.